Hey everyone, thanks for joining. I'm Denise Loria, Special Projects and Operations Manager at AFC. We're thrilled to bring you this webinar today. We're going to be talking about KYC, also known as Know Your Customer. We have a stellar lineup. This webinar is in collaboration with our partner Jenner and Block, and we have panelists from Oscilar, Pathward, and Stearns Bank. I'm going to pass it over to Jeremy because I feel like we have so much to cover and I don't want to take up too much time. So Jeremy, take it away.
Thanks so much, Denise, and welcome everyone to this webinar. We assume that you're interested in KYC. If you're not, you're in the wrong webinar because we're going to go deep into KYC, the arcana of KYC. This is what's new in KYC, how new business models and shifting government priorities are affecting requirements. So I'm going to take a minute just to introduce our stellar panelists. First, Becca Kronlund. Becca has really been a leader in the BaaS world and as in-house roles for many years. She's currently the Deputy General Counsel at Pathward, which provides fintech partners with a whole range of BaaS services, commercial finance, payments, compliance infrastructure, and much more. Before that, she was the General Counsel at Stearns Bank. Welcome, Becca. Next, we have Patrick Slane, who's the VP and Director of FinTech at Stearns Bank. And in that role, Patrick partners with tech companies to embed financial services into their products and he advises the bank on VC investments and other matters. He's also a founder, a strategic advisor, and an investor in his own right in this space. And last but not least, well, before I introduce Laurel, who will be my co-moderator, last but not least is our panelist, is Saurabh Bajaj, who is the Chief Product Officer of Oscilar. At Oscilar, he is building the first generative AI risk management platform to combat fraud. And he's really at the forefront of the intersection of technology, new technology, and KYC. He's before joining Oscilar, he was the executive and GM at Shape Security, the chief product officer at FeedsEye, and the head of product at Newstar. He's also an investor and strategic advisor in his own right. And then last but not least, as my co-moderator and partner at Jenner and Block, Laurel Rimon, who is a co-chair of our fintech practice. Laurel spent over a decade at the Department of Justice and prosecuting financial crimes, and then was the deputy chief of enforcement at the CFPB. And in private practice, Laurel advises fintech and digital asset companies and banks on KYC, enforcement, and many other matters. So welcome to our panelists. I'm going to begin really with sort of foundational, definitional questions about KYC, because, of course, our audience is probably very familiar with the term, but I think it's worth talking a little bit about its definition and scope. So I'm going to begin actually with Laurel. So is KYC actually found in any statute or regulation?
It's my little fun fact. Thank you for asking that question. Everybody talks about KYC as if it's a well-established thing, which it is in terms of expectations, but the term KYC or Know Your Customer itself doesn't appear in any of the Bank Secrecy Act or AML laws or regulations. And I know we're going to talk a little bit about what we're going to talk about in terms of KYC and what KYC means. In the world of fintech, in the world of crypto, people throw around KYC all the time. They understand that generally you have to know something about your customer, but what it really is a shorthand way to refer to the customer identification requirements and customer due diligence requirements, kind of all in one ball of obligation. So it's both a specific requirement and also very non-specific. And I think our other panelists are going to talk a little bit about what KYC means to them. But I always think that's a little fun fact to start with, and really to just point out that there's some real art to it. It's not a check the box exercise. There's some real knowledge and understanding that needs to go into successful KYC.
People, you know it when you see it, but it's hard to define. So, Beck, I'm gonna turn to you. Can you tell us a little bit about your understanding of KYC, what it is, and also specifically how it's evolved in recent years?
Absolutely. I echo what Laurel said. I thought that was a great definition. It's funny. It's hard to pin down a definition, but it is an umbrella term. So at its base components, I think about KYC as first SIP or CIP as the initial step where the customer identity is being verified. And the next component being CDD or customer due diligence, the ongoing process where you're continually monitoring customer behavior for anomalies and suspicious behavior, as well as assessing risk on an ongoing basis. And then enhanced due diligence as part of that CDD that you're going to apply to high-risk customers, where you want to dig deeper, do more investigation, and monitor based on their risk profile. Each of them, I think, are pivotal, really, when we talk about KYC and preventing financial crime. As far as the emerging trends, I think what people have been asking a lot recently in the current environment is, are the KYC requirements right now loosening? Recently, we've seen definitely a change in the tone at the top, where as a whole, it feels like there's a risk-based rationalization of banking regulation, which is ongoing. So for the industry, I think that's positive. However, generally speaking, bank regulators are not stepping back from KYC and BSA, which tends to be more politically agnostic. And also, I think when you think about KYC currently today with the administration, you want to also understand it's going to change, right? In a couple of years, regulators can always look back if they want to. So that message is, stay the course on KYC and BSA. And then I think you also want to think about recent enforcement actions in this space, which I think have underscored that examiners are really have heightened expectations around BSA AML when it comes to partner banks and fintech programs. That's a definite theme that's emerged there. So I would say while regulators are not backing away from KYC, there is an emerging trend to take note of that's important towards modernization of KYC. The SIP rule has been out since 2002, I believe, 23 years. And when it came out, banking was largely done in person in branches. So since we're now in a very different world when it comes to banking, driven by consumer expectations for digital banking, I think there is a movement that's being recognized by the regulators and trying to modernize and match it to the environment that we're in. Two things to note that have come out recently that I think are interesting along that theme. In June, FinCEN published an order regarding collection of CIP, and all the banking regulators joined that order. The original CIP rule provides that banks must obtain the minimal SIP information from the customer, is the rule, prior to opening an account. The FinCEN order allows banks to use alternative collection processes and obtain all or part of that TIN as part of the SIP information from a third-party source, rather than from the customer directly. And the reason for this change and what was driving it is really the rise in online banking services. With data breaches and account takeovers, consumers are reluctant. We're all consumers. When you enter your social security number online, a lot of us do pause. So it's recognizing that consumer protection and really, I think, giving some flexibility. And then in August, the FDIC revised their interpretation of what collecting SIP information from a customer means. And they're allowing financial institutions to pre-populate that information, such as an account opening form where that information can pre-fill. So I think those are two examples of recent upgrades to that SIP rule. And to me, looks like a rethinking of legacy rules to really address, some hurdles, some concerns, and make customer acquisition ultimately a little bit easier.
That's great. Thank you, Becca. So, those are kind of efforts to modernize processes to some degree. They're kind of incremental and not, foundational in terms of big changes. I want to step back for a second. And Patrick, I want to ask you a little bit about business models here and sort of which are changing in pretty dramatic ways with the rise of embedded finance and even BaaS seems like an ancient word now. I want to sort of, if you can give us a sense a little bit of how the different business models that we're seeing, that are pretty prevalent now in the market, embedded finance, BaaS, are affecting KYC? Or is there a different understanding of or different shape of it or definition really in each of these business models, or is it basically the same?
I think I'll start with making sure that there's at least my understanding of what embedded finance is versus what banking as a service is, and not just an ancient word, but in some places a bad word from how regulatory action has gone over the past few years. So how I view embedded finance versus banking as a service is where the bank and their services are embedded into a technology providers, where the bank is performing all the activities on the back end and running all the services, whether it's KYC, transaction monitoring, and not delegating those responsibilities to the fintech providers or fintechs that they're sponsoring. On the other end of the spectrum, I've known banking as a service as more of where more responsibilities are delegated. But as it relates to KYC, the bank is ultimately responsible for KYCing and ensuring that the bank's BSA policy and program is met, regardless of which model you're using. So whether that is implemented via a fintech that you're sponsoring or by the bank directly, a lot of that will be dictated by the institution's BSA policy. But as it relates to whether embedded finance or banking as a service, account holders do need to be fully KYC'd under their BSA program.
Is it, just to follow up to that, KYC applies in both contexts. The bank is ultimately responsible, but are we seeing more confusion about who does what sort of and who's responsible in terms of the actual getting it done because of these different business models that are becoming more prevalent, or is there pretty much clarity on it?
I think you're seeing a little bit, or you historically saw a little bit more ambiguity around it. As time has gone on, there's been a lot of feedback and regulatory actions that have been taken specific to BSA and AML CFT obligations of financial institutions. So over time, at least as I've onboarded different fintechs that have been sponsored by institutions I've worked for, we've created a lot more clarity, both in the BSA policy and program, as well as in the contracts with those providers to say, these are exactly our responsibilities versus your responsibilities. And that has gotten more and more clear over time because we want to make sure that as we are explaining to our regulators who does what, that we can be very clear and there's no questions asked as to who is performing what responsibilities and who is responsible for what.
Thank you. So, Saurabh, I want to turn to you and focus a little bit on the technology here and its impact on AI. And I guess I want to ask you sort of the same question, but really through the technology lens in terms of how has your understanding of KYC and what it means shifted with the technology and the rise of Gen AI?
Interesting question. I think technology, there's always an inflection point where technology comes in. I think the market demands, if you see from what Patrick mentioned, whether it's BaaS or embedded banking, that's number one. Number two, you kind of really look at the instant gratification of user experience. We need accounts opened within minutes. How does that now translate into requirements of KYC? Number three, you look at a lot more cross-border kind of payments and transactions happening, and how does that kind of create pressure from a technology perspective to introduce rails, apps. And you see this from a perspective of stablecoins and how people are now evaluating stablecoins as a viable mechanism to transfer money from US to Mexico with a fraction of the cost. And then, of course, KYC is becoming a competitive advantage as well, right? If you can really seamlessly make a customer go through an onboarding process, you will have a better way to accept a customer, retain the customer, a higher LTV, right? Now, the flip side of all these market pressures is like, what does a team do from a technology perspective to make decisions, and how do they sift out the good from the bad? And I think the bigger problems here are, even before the generative AI world, data breaches were common. They're a norm. So we can all expect that Saurabh, Bajaj, my name, my address, my SSN, everything is compromised, right? We should take that for granted. That's how good security and risk teams operate, right? Assume everything is compromised. How do you deal with that information? Using another KYC solution, which is going to do name, address, phone number, SSN match, is not going to work, right? It's easy to do that. And so these databases definitely provide like a fundamental challenge of how do you do more continuous monitoring? But that doesn't solve the problem. That's very, very, very incremental. We have seen how deepfakes have come in, and we've seen videos of amazing professional athletes, of celebrities, of how they've been convincing through scams for people to kind of give in money, given their identity information, fish information about their accounts, about their credentials, give their account information as well, right, from a payments perspective. And so deepfakes have defeated a lot of the tools that yesterday were great, like selfie verification, liveliness check. They were all amazing like 5 to 7 years ago. Now they can be defeated. And of course, there are challenges around creating authentic documents as well. So the doc verification services, you can see how many false positives they will generate. So these are kind of the inflection points that are kind of accelerated because now generative AI makes it very easy for the common attacker to create videos, audios, photos, content that will bypass like the traditional or even the more modern KYC solutions, I would say. So that's kind of my viewpoint of how things have changed and why it's, uh, in my opinion, we're kind of in an identity crisis world where we need to figure out what does identity mean, how does KYC evolve as a definition, whether it's legally or not, and how do folks look at KYC as a more robust process for identity verification and continuous monitoring as well.
Jeremy,
Yeah, go ahead.
can I jump in with a
Yeah, of course.
question? I think Saurabh just listed out about 25, key questions that we could spend an hour talking about. So I'm sure you're going to follow up on some of those. But I wanted to ask Patrick and maybe everybody, but picking up on something Patrick said, thinking about many of the, sort of partnerships that are out there and the division of labor, which I agree is getting clearer, although sometimes, the devil is in the details when you get down to really starting things. But I'm wondering, how do the folks here deal with the fact that you may have onboarding by one party? Maybe it's entirely by one, maybe there are aspects that are handled by more than one party, but then the due diligence aspects may be informed by activity that's more on the back end and that sort of thing. And so one of the things that's a challenge in KYC is sort of integrating the data. And I was thinking about this when Saurabh was talking. It's like, okay, you may have the onboarding information, but you also have to have the transaction, data. You have to understand what their business is, and they may all exist with different parties or certainly different databases and all that. So I was wondering, Patrick, if you had a thought, maybe, Saurabh and Becca as well on that issue.
Yeah, I mean, it's incredibly challenging, right? Especially if you have disparate systems or disparate parties that are obtaining the information. To your point, like you may onboard with a KYC provider and then ongoing data comes in through different providers, whether it's an AML CFT tool or whatnot, and being able to manage across those platforms is very challenging. I don't know that there's a perfect answer yet. There are tools that are doing more and more across, and there are tools that you can do testing, automated testing with. So, that's a lot of what I've been looking at recently is how can we kind of pull data from these disparate systems to see how we can aggregate and get the transaction data as well as the upfront data and onboarding data to create a more holistic picture of our customers. But that it's an ongoing process. You have Gen AI that is able to create, synthetic identities. And then if there's any transaction, like if they get through KYC and then there's transactions that start running, the world is continuing to evolve and it's getting harder and harder. And you, Saurabh, you probably see it even more than I do, and probably Becca as well.
Yeah, I can add a bit. This is the exact siloed risk infrastructure problem that we are seeing right now. Whether it's the BaaS side, embedded banking side, community bank side, traditional banks, you have one solution that you're using for some credit decisioning. You have another solution you're using for onboarding, whether it's KYC, KYB. You have another solution that's doing payments, and then you have yet another fourth solution that's doing AML transaction monitoring and sanction screening. How are you going to establish the definition of an entity identity, right? That's number one. Number two, you might have had a KYC score and a customer risk rating established during onboarding. How does that now cover the entire life cycle of the customer when they're doing ongoing activity, changing their addresses, making payments, doing wires, adding new products? It's just a complete mess. So when you're kind of looking at establishing who the customer is, that's broken. You don't have a single view of the customer. Second, that information doesn't pass through during the transaction monitoring process, which is another big challenge, right? And then if you don't, then how do you kind of do the continuous monitoring or the customer risk rating or the EDDs, and how do you show the regulators that you're doing a good enough job? So that's the problem we see, which is fundamentally you cannot make decisions on siloed solutions anymore, right? Best of breed doesn't work anymore. You could be perfect in solving this problem, but the problem is more transversal problem you're trying to solve, not a deep problem of getting the best one quality data. It's about, if you can't build the whole picture of the person, it doesn't matter if you have the best ear or the best nose, right? That's kind of how I put it. And so that's kind of where we've been helping community banks really figure out how do we tie these pieces of the problem together. So which means you need to have a data platform that can integrate any data, whether it's first party data, third party data, right from onboarding to monitoring, and how do you streamline that? And then what are the strategies that you need to create on top, which are not siloed solutions, but kind of like same parts of the brain that are putting the piece of the puzzle together. So definitely a big challenge. I echo what Patrick mentioned here as well.
Is that this may be a softball, sorry, but where does agentic AI and other very new AI technologies fit in solving the exact problem you're talking about? I mean, is there a way to do it much more easily and cheaply than just a year earlier?
So the business pressure that we all talked about, and Patrick mentioned embedded banking, there's cross-border, there's embedded banking, there's instant account opening. All of that is creating so much more pressure, and the products from these fintechs banks are also more diverse than they were like 5-7 years ago. That one solution that fits all doesn't work, right? And so that means you're going to generate more false positives because of the traditional tools you see. Now, when you generate more false positives, the outcome is more alerts, more cases, more SARs, right? When you have more alerts, more cases, more SARs, it means more humans to look at it. And so definitely traditional banks, community banks, they do not have the luxury of resources to go in and say, you know what, we're going to deploy 10 more people because we've onboarded 5 more programs and each need an oversight and monitoring. That doesn't work. It doesn't scale. It won't be a profitable business for them to grow as well. So this is where agentic AI kind of really comes in and really helps understand how we augment different parts of the process, right? Whether it's in onboarding, whether it's in kind of really understanding when you're maintaining these strategies, right? Like you have a KYC onboarding strategy, how do you kind of really look at the outcomes of those onboarding and figure out what was good, what was bad, and then have an agent be able to help you tune those thresholds or rules for KYC that allow you to kind of reduce those false positives. So that's one where you can have a rule recommendations agent or a KYC agent that is basically helping you optimize your decision thresholds. Second, of course, in the ops side, now since you will have all these alerts and cases, how can you have a better platform that understands the context of the user overall and then help you augment decision on L1 reviews, L2 reviews, whether it's for KYC, whether it's for transaction monitoring, whether it's for sanctions. You should not be spending 1 hour writing a SAR narrative. You should not be spending 30 minutes looking at a SAR, a case. You should not be spending 10, 15 minutes on alert. So can you cut that to a fraction of a time where Sherlock Holmes investigation from an agentic AI perspective does all the heavy lifting of gathering the information, putting the pieces together so that an expert is looking at it and saying, yep, makes sense. And that's kind of how you would scale. And then you have to figure out where you draw boundaries around automation for agentic AI as well. Yesterday, I was discussing this with someone. When you classify something as suspicious and you know it's going to be result in SR, why not automate that process completely, right? There's no fear of false negative here. It's only basically you're generating SR, which is a great thing. And so there is room for automation around decision boundaries and thresholds when you do deem something as a productive alert or something that is SAR worthy, and how do you do automation with agents around that as well?
And is there a sort of, that sounds like fairly near term. Is there a kind of a much longer term technological solution here that you see transforming KYC dramatically, or is it sort of just more incremental progress towards solving this holistic, the siloing problem?
I think that a lot of the problems that we have to solve are related to how data comes together, what is that right risk infrastructure, and we have solutions for all of those in the industry from a perspective of, for example, what we are doing at Oscilar as well. But I think if you ask me to bring up a crystal ball and say how a lot of these problems will be solved, you could have agents who are basically doing RFI, right, when you don't have enough information. So how do you kind of shrink the time to do a lot of the processes that are manual? And when you're interacting with the customer, because you need more information, you can also suss out if there are patterns of abuse, mules, behaviors, because you're collecting a lot more digital data passively to authenticate folks, right? And so I think what we have underutilized is the digital interactions and how we use these digital interactions to enhance the definitions of KYC and how they inform what it means to have a good user, a mule, a bad user. And this gets even more complex in the agentic commerce that everyone's talking about with Anthropic and Stripe kind of releasing ACP. So the concept of digital identity, tokenization, how we look at those behavioral biometrics information, which is spoof proof, and how we use that in the KYC process for automation of decision, I think is going to be super, super valuable.
Let me ask you, Laurel, a question related to this, and this is a question that came in from some of our audience, an audience member. This is a dizzying kind of vision of technology's impact on KYC, and it's hard to imagine regulators keeping up. Can you give us a sense of what level of AI automation and AI usage regulators are comfortable with now, and how you see that developing?
Yeah, I mean, that's a really tough question to answer, and I'd be interested. I'm sure, Becca, you might have thoughts on this as well. But I mean, it's well known that regulators are not, ahead of the game on AI. I mean, we would consider them generally behind the game on AI. A place that I might generally put them ahead on the technology is on blockchain analytics, interestingly enough, in their affirmative use. If you've got digital assets involved, they're sort of ahead of a lot of companies in terms of doing that proactive review of blockchain transactions. Not necessarily AI, but just an area where I think that some regulators are kind of ahead of the game. But in terms of their understanding of AI, the way I look at it is, or understand regulators to have been approaching this is, they know what they want. They know what they want to see. For instance, when it comes to KYC or customer due diligence, one of the issues that comes up frequently in enforcement actions is the failure to identify shared attributes across different users. So making connections between, a user might have multiple accounts, maybe that's not permitted, but it happens anyway, or you have a user that's, got using the same address, and that may indicate some suspicion or something like that. And so, that's an area where I think certain AI tools would be very useful to help sort of crawl across the data and understand and make connections that a human may not make. Although, again, that comes in where we have different databases and that sort of thing. So I think a regulator in an instance like that isn't going to care how you get it done. They're going to want to see that you get it done. And they definitely are pointing out the absence of that capability. And so I think for a while there was this sense of like, we don't trust AI. And it was just this big sort of nameless, featureless, concept. And now I think regulators themselves are getting are having walkthroughs by product companies. They're understanding how it's used. I think they're having a hard time onboarding it themselves, as government agencies do, but they're much more familiar, and they're familiar with companies using it. So they're very open, but it's really a results-oriented thing, I think. And so that's how I look at it. Certainly, should be used. The other area where I would note some, skepticism perhaps, is there's always the pressure from regulators on the staffing question. Every enforcement action you see has a staffing element to it. And regulators tend to find that the staffing is insufficient, not sufficiently qualified, and that sort of thing. And I think there's some skepticism around the idea of, well, we didn't need the 10 people to do this because we have one AI tool, and there's absolutely going to be skepticism about that. But if you can explain why and show the results, then I think there's an openness.
And that's an interesting, and I think that's what I've heard as well. In our discussions with FinCEN and many other of the folks, I echo what Laurel mentioned. I think they want to look at that the outputs are same or more outputs, right? And so if you're doing more with AI, that's amazing for them, right? Their concern is, of course, if you're just automating without intelligence. And I'll give you an example that I shared with one of the regulators, which is like QC, quality check is usually a process that a lot of people do. How do we do quality check today? We'll take a sample of 5% of the KYC alerts, and we'll send it to a review queue, and somebody will manually look at those 5% of the alerts and say, okay, were they dispositioned right or not, and then have learnings. What if you had a QC agent, which instead of doing 5%, would look at all the 100% and have a review process, right? That would be amazing, right? I mean, nobody would deny not having 100% of your alerts being QC'd by an agent. And then out of that, maybe sample even fewer, not 5%. Maybe it's only 0.5% because now you have done a thorough QC job. And as you learn the QC blueprint of that policy, that product, you can refine that further as well. In my opinion, if you take that to a regulator, they'll be more happy that you're basically doing these audit processes, these tunings, these monitorings even more frequent. And that's what they care about, which is, what does the process look like? Can you convince me that the process is knowledgeable, it's adaptive, and you're tuning it and you're on top of it? It's less about whether you have 1,000 people doing it or 100 people doing it, right? As long as the outcomes are meaningful and they resonate.
Well, we may come to a point where the staffing question is answered by having a certain number of agents and a certain number of humans, and no one bats an eye at that division. Becca, let me just give you an opportunity to comment on any of this. In your experience, how are regulators approaching these issues, either the technology question, the AI question, or the sort of division of responsibility question on the KYC front?
Yeah, I would reiterate what everyone said. I think we've covered the division of responsibility. The regulators, just generally speaking, generic is bad, right? And you've got to really dig in and be specific, have, product specific procedures on top of a well-written policy. You can't just stop at the policy, but they're going to want to know how you operationalize, right, each of those, what those roles and responsibilities are, and that there's clarity, because I do think that a lot of trouble happens when you've had that lack of clarity between the bank and fintech and who's doing what and who's interfacing with the customer. In the traditional model, the fintech, one of the models is they're having most of that customer contact. The customer associates the fintech brand, right, with the services they're receiving, the bank's in the background. At the same time, your policies and procedures need to reflect that, be on the same page about it, but also understand the bank's going to hold that accountability and responsibility at the end of the day, as we've said a few times. On the AI piece, I think generally speaking, I agree with the comments here, and that's been very helpful. I think some of the things that the regulators are concerned about, they're going to look at this from an existing framework in their mind, from a risk management perspective. Is it risk-based? Have you identified the risks of using your AI tools? And have you addressed those risks with controls? So they're going to apply that same framework to these tools that you're bringing into your bank. I think things that they're going to pay attention to in particular are going to be tools you're using for credit decisions. You know, that's an area where I think there's a lot of good innovation out there, a lot of fintech partners who want to use that innovation. And I think what you've got to be concerned about is understanding where the risks are in that. So is there some bias in the system, you know, in the AI that hasn't been addressed? Are you doing the appropriate fair lending look and testing on that? That's something that's going to be a focus. And then I think it's always going to get back to data privacy as well, and making sure that you've addressed those concerns. You've thought about it. You've done the same third-party risk management, right, on these vendors that you've always done, but with an eye towards, you know, being risk-based.
Well, that's
Can I jump
Go ahead.
in to make my
ahead.
pitch related to enforcement? Because all of the points, Becca, that you're making are so important. The risk assessment, the risk assessment as a term of art, but also just sort of generally like what are the true risks here and all of that. And what I see when I'm dealing with companies as they're engaging with regulators, whether it's at a supervisory level or if something has been referred to enforcement, is that the documentation of these considerations is just not adequate. I mean, people know how to get a risk assessment. You know, regulators know what they expect to see. There's sort of a format to these things. We hire consultants, they do the work, but a lot of times they're just too generic. They're not specific enough. They're not incorporating the tools that are going to be used and really articulating the specific risks that the company has identified over, you know, time related to a particular product. Or if it's a new product, the anticipated risks, it's just too generic. So this is my pitch, my plea for those companies who are listening to think about what the documentation looks like, so that if there were ever a question, you have a document that you can hold up and say, yeah, we may not have gotten it 100% right. Nobody ever does. That's not the expectation, but we thought about the real risks and we intended to address them through the use of these tools or procedures or whatever it is. And that's the end of my public service announcement.
Well, I'll just add one thing which comes out of our practice, which is just the two areas that you mentioned, Becca, the credit decisioning, you know, concerns about bias in the use of machine learning or AI, and the data privacy concerns. That the other thing to remember there is it's not just the prudential regulators, right? Because there you're implicating, in those two things, you're implicating the state AGs, you know, the state authorities, consumer protection, those all the other regulators. So you suddenly have, it's not just a question of, you know, additional areas, it's also additional regulators who are implicated and who have that focus. And that's obviously particularly important right now where you have, you know, a sort of federal retrenchment potentially, and maybe some relaxation on the federal level, but but not on the state level. Let me Laurel, let me just ask you another question related to this. Where do you see companies getting tripped up most when it comes to their KYC efforts? I mean, as you mentioned, the risk assessment issue. Are there other red flags or issues that you find that you just want to call out that regulators are particularly attuned to or that you see?
Yeah, I'll mention a couple. And I think, again, some of this may go back to what Patrick was saying, but where there's sort of an apportionment of responsibility in terms of the KYC and the onboarding, and maybe there's a sort of collective effort. One party has one part of the obligation and the other party has another part, and then there's a transfer of information that may be necessary. You know, it's absolutely true the bank retains the obligation, the responsibility, but sometimes it's a little bit unclear who's actually doing the work. Another areas where you have affiliates involved in servicing products, maybe across borders and that sort of thing. And it isn't even always clear who owns the customer relationship. Maybe one affiliate is onboarding the customers, but really they aren't their customers. You know, you really have to get into the details of the flow of funds to understand where the regulated activity is. And so therefore, who owns the customer relationship? And so which rules apply to the KYC, you know, the customer identification and due diligence. And probably where I see the biggest problem is where you really have a divorce between who's doing the onboarding information and who has access to what might feed into the due diligence information, and you're not able to marry those. And those are, sort of, at the end of the day, it kind of comes down to data ownership and access and sharing and the ability to review all the relevant data in one place.
Is that, let me just, the question came in actually from the audience, which is relevant to this, which is there a sort of, are the concern or the red flags you're raising exacerbated by use of vendors as opposed to, in-house manual processes, or are banks and regulators agnostic as to whether you have another vendor in your universe, or whether you're doing it in-house manually?
I saw that question. I'm going to mention just one. There's a mention of manual processes, and I'll just say, what I think about when I hear the term manual processes is like an Excel spreadsheet, a Word document. And here we are talking about very advanced AI. Saurabh is talking about these amazing opportunities, but I guarantee you everyone on this call today is aware that there are people today using like a Google Doc to track things, or an Excel spreadsheet to do, manual transaction monitoring. I mean, I see this every day. I think generally across the board, that's a problem. That doesn't mean, meet regulators' expectations almost always. But the question of whether it's a sort of a, the build it or buy it question, I'll leave to others on the panel.
Yeah,
I can shed some light on this, Jeremy. I think, like Laurel mentioned, there are manual processes, people working on spreadsheets. I'll use the term, no one gets fired for following manual processes if you can do them at scale. But usually why we see some of the banks cling on to manual processes, because they're early on in the process, they're onboarding a first partner, they have a new product, they want to kind of really have the control and accountability, because when regulators come knocking, they need to explain every decision, and they fear like if a new technology comes in, it'll be a black box that they can't defend, right? And so that's definitely one of the driving concerns of when an examiner will ask you, like, how do you know that the vendor is compliant, or how do you kind of prove the vendor oversight, and they have to learn a new system and to kind of show that and not worry that they'll falter. I think that's kind of what creates the institutional inertia, and they've built teams around manual processes, right? So they just feel more comfortable with it. But this doesn't scale like beyond a couple of partners, or as you kind of look at more programs or more products. And so if you want to scale, if you want to add more, you have to think of what does it mean to add not just like the AI part, but just automation, right? Automation which is deterministic, that can help them in ways to kind of really get a sense of what they're doing and how they're doing it. And what banks really care about is the new technology. Can it be explainable, not just AI? Are there going to be integration pains, because you'll integrate with the technology and then you'll have to manage the vendors? No one wants to manage vendors, and that kind of becomes a problem. You have a support ticket and it takes days or months to kind of respond to that. And then like with vendor risk, right? There's so many newer generation, first time founder type of technologies. There's like financial stability. What if they go like out of works in like a couple of years, right? So while they might be fancy as agentic tools, but you don't know the future in 2 years and what happens. And then of course, like, are they again a siloed solution, or are you looking at a whole spectrum of things?
That's really helpful. There's a lot there. Let me switch gears a little bit, and just, I think would be remiss if we didn't talk a little bit about crypto and its impact on, some of these questions. Have you, I'm going to open this up to the whole panel. So anyone who's had experience with this, really, is the impact of, and particularly with this, under this administration, the impact of the crypto landscape becoming, much more active and much more, the regulators much less hostile to it. How is that affecting KYC in your respective fields and of sight? Patrick, have you had any insights on that recently? It's sort of a whole new world.
Yeah, I mean, as it relates to KYC, no, I haven't directly engaged with many companies. I mean, I've looked at opportunities that are crypto adjacent, And there's opportunities, but there's also scaled ways of approaching it, right? So maybe not being directly in the flow, on ramp, off ramp, but being able to see how it's done from a fintech partner that you may have that you're looking to pursue business with. Maybe there's a fiat portion of the business that a bank can sponsor, to be able to see how it's done and how that particular fintech partner does it, to gain exposure. But beyond that, I haven't directly had much engagement beyond that.
The learning curve for banks is pretty steep right now. Given
there's a lot of announcements, right? Like there's a lot of, Circle going with, I think it was FIS, and but there's not a whole lot of. I was actually just talking to someone about this the other day. There's a lot of announcements, but not a whole lot of like operationalizing any of this yet. Especially as it relates to financial institutions. And that's going to be probably the next big step, is how do you operationalize the announcements and the, flashy stablecoin or crypto initiatives that are being thrown out there.
Yeah, that's a good point, Patrick. And if you think about the, stablecoin as an example, and we now have this new federal framework for stablecoin. It's just a few months out there. I think there's a lot of figuring out what that means and how to work that into your processes if you're a bank that wants to support products and services involving stablecoins. So if the requirements that are that law are to maintain 100% reserves, for instance, and undergo audits, you have to operationalize those requirements, incorporate that into your KYC checks, and so forth for those issuers.
We work with quite a few of these crypto stablecoin customers. I think at least what we have observed at Oscilar is there's a fundamental conflict. Crypto in general is built on the pseudo-anonymity and decentralization principles, whereas regulations demand like full identity verification, and that's kind of a bridge where everyone's asking a question: what's the right thresholds of these opposing philosophies? And so it has kind of exposed some challenges in traditional KYC, because in crypto, for example, geographic boundaries, it's meaningless in crypto. There's no concept of like single identity. Users have like unlimited wallet addresses. Institutional gatekeepers are not kind of that important. DeFi kind of eliminates like these intermediaries. And then you have transaction monitoring that you're thinking of on-ramp, off-ramp, but now you have on-chain activity. It's visible, but the identity is unknown. And so you have new challenges around wallet addresses aren't identities, cross-chain transactions are like obscure fund flows, and then you have mixers and tumblers in between. And there's a regulatory scramble around like how exchanges need to do like full KYC, like traditional banks, and then the DeFi protocols, they need to mostly look at like unregulated gray areas. And then wallets, they vary by jurisdiction that you operate in. And then there's like added nightmare around like the travel rule. What is it when you're sending and receiving transfers which are greater than 3,000? How do you KYC a wallet address? Exchanges can't control those external wallets. And then this kind of poses like, what does crypto native identity solution means in terms of tokenization, in terms of on-chain identity, disclosures. So there are kind of real world impacts for both traditional banks and crypto businesses. But the dilemmas are all about, do you maintain two systems now with the on-ramp, off-ramp, and the other one is on-chain? And so it's creating new problems, more false positives, more unknown identities. So there's definitely a fork in the road of how we kind of come to what are the right processes, but everyone's kind of figuring that out by trying.
Well, it's a resource question, presumably too. So to have the resources to be able to do that may separate certain institutions from others, right? Laurel, what have you been seeing in this area?
Yeah, well, I'm seeing a theme here, Saurabh. You mentioned like 20 new different topics. We could spend a lot of time on each one. I think I have a slightly different view. I mean, I'm really interested to hear about, sort of the digital identity, that sort of piece. But my experience, like sort of on the day-to-day, is that, I mean, you have centralized finance when it comes to crypto, and you have DeFi, and maybe the rules are a little gray when you have DeFi, but the reality is, most of the time when I look at a platform or operation, it's truly centralized. It's really not decentralized. I mean, there certainly are decentralized platforms out there, but a lot of what we do really does fall within the KYC and AML obligations, whether you have, fiat, crypto working together, which you often do, or an exchange or whatever it is. The issue to me is that you have different systems, primarily regarding who your customer is and what their risk is. Like, so for your customer risk rating or those kinds of issues, you have to both look at the fiat piece of the transaction and you have to look at the crypto piece of the transaction. And monitoring those things are different. The systems are different, the questions are different, the behavior is different. All the things that you point out, Saurabh, I mean, in terms of how people act and the sort of, where are they? Does it matter? What is their identity? All those things are different. And so when you introduce crypto, you have new considerations around the obligations that pretty uniformly, if you're talking about payments, and you have, you sort of the markers of a centralized platform, which is someone operating it, someone making money off of it, those kinds of things, then you probably fall under those. And so that just introduces some different complications. And then you have the challenges of integrating those two systems, because people use one system to monitor their fiat transactions and one to monitor their crypto transactions. And so there's a challenge there. And I guess the other piece I was thinking, to Patrick's point, is, and Becca, is that, you have the sort of institutional and enterprise questions about whether you're going to do stablecoin or some other sort of crypto activity. And then you have the pretty open door now, compared to just not very long ago, where crypto platforms could barely even get a bank account anywhere, just for their operational purposes, let alone for, their actual transaction activity. And so you have this sort of banking of crypto activity in a different way, and that feeds into knowing your customer, and many more crypto, business models that are sort of popping up. And so I think the introduction of crypto definitely, it's more of the frontier, and it raises a lot of these new questions, but it mostly needs to fit within the framework that exists under the BSA, unless you truly have a decentralized platform. And then we can talk about that in a separate webinar. It's very complicated. Nobody really wants to buy into the BSA obligations if you're decentralized. Totally understand why, but you probably need to do something to know who's involved in your platform. Otherwise, you're in big trouble. So there's a lot of issues here. Definitely changes the game a little bit. And I think even for traditional finance, whether it's banks or other, non-bank fintechs, if you're touching crypto in one way or another, you have to get pretty educated on how that changes the risks.
Well, Laurel, that's a good segue to the debanking executive order and the requirements coming out of the White House and the prudential regulators for banks to rebank, in essence, and remove reputational risk as one of the factors in the KYC process and in other processes. I'm interested in Becca, Patrick, how is that playing out on the ground in terms of compliance with that requirement, and what are the issues that you're seeing going forward in that area?
Sure, I can add a couple just quick thoughts. I think I'll say, debanking is always a concern, and I think it's right to at least put some focus there on it, like we're doing today. Obviously, banks do everything in their power, I think, to avoid debanking. But generally, what I would say this means going forward for banks is, you've already noted, Jeremy, you can't have a dismissive, sort of basic description for your decisioning, whether it's, a KYC decision or just more broadly, let's say, a customer decision, an account closure. You're going to need to be more specific and granular. We've been talking a lot today about documentation and oversight failures coming down to and involving lack of documentation, you're going to want clear justifications on your decisioning. And again, not referring solely to reputational risk.
Yeah, the documentation is clearly going to be key for that. Patrick, do you have anything to add there?
I was just going to agree with Becca and say, in addition to the documentation, just making sure that you're being consistent across your entire customer base. Consistent delivery and consistent execution of how you implement your policies and procedures and how you approach your KYC process is critical.
Yeah. So I think we have a few more minutes. Laurel, I just want to end possibly with a discussion of something that I think you're really one of the nation's specialists in, or one of the only people who actually has this particular dual expertise, which is on the one hand, consumer protection, and on the other hand, sort of anti-fraud measures and AML. And I'm interested in what are you seeing now recently in the KYC realm, the balance between protecting customer access to accounts and the sort of customer facing aspects of this, and on the one hand, and the KYC, anti-fraud measures on the other, from regulators and also just in the industry.
Yeah, I mean, it's a lot, we won't be able to touch on it in just a few minutes, but there are some things that, that come to mind. And you're right, like I come at this from a former prosecutor on the financial crime side and a former CFPB enforcement attorney. And I know that the two come together, and regulators are very often not aware of the pressures they each bring. So on the one hand, you have consumer protection issues that regulators and state AGs really care about. That's consumer access to their accounts, account freezes, account takeovers, fraud, identity theft, all of those things, which might make it difficult for a consumer to access their funds. And you have law enforcement requests, which sometimes cause a financial institution to shut down an account. And then you have AML requirements and financial, anti-fraud and financial crime requirements that make it imperative that financial institutions be watching for this type of activity and take action. Maybe suspend access for a period of time to ensure they know who the true owner is and understand whether there's been an account takeover or something like that. And so all that makes the KYC and customer identification and understanding about customer expected activity and source of funds and all of those issues just much more important and on point. And there, I think, it brings to, I forget who mentioned, someone else on the panel, just sort of immediate access, immediate account openings. There's an expectation that these things don't take 2 weeks where you sit there without access to your funds. And so that means having reliable data sources, having procedures that have gotten you useful information about who your customer is, become that much more imperative, because the risk is a regulator is going to see that you've interfered with the customer's use of their own funds. And that's a really dangerous, an important area to be aware of.
I mean, this may be an area where technology, and here I'm sorry, may have an insight into this, that technology may be making this tension less of a tension. I mean, ideally, technology can deal with the consumer protection, the need for instantaneous access and faster processes, more user-friendly processes, and at the same time, on the back end, deal with the fraud issues more quickly and more effectively.
Yeah, absolutely. I think the theme that I heard from Laurel, Patrick, Becca is like, be more consistent. I think you cannot create more silos of decision engines. We talked about the silos from a perspective of credit, fraud, onboarding, AML transaction monitoring, and now you're adding this on-chain, off-chain silos and tools and processes. So how do you kind of really make sure that the platform that you use is bringing that singular orchestration view of the data of the customer, so that whatever policies you create, right, you're creating on a common shared platform and understanding of the data and the user. That itself is a big winner and drives a lot of coherency, consistency of how you think of your policies and what to do next iteratively. And so I think that's where technology becomes an enabler in like organizing your knowledge and organizing your data so that you can find it better, you can act on it better, you can explain it better. That's how I view this as this new dimension of a platform as an enabler. So my last parting thoughts might be like, don't make choices on siloed tools again.
Well, I'm glad we're leaving on a more optimistic tone, because things got pretty gloomy there for a while. So I want to thank our panelists and thank the American Fintech Council for hosting us. And I want to thank all of you in the audience for listening to us. Hope you've learned something. I certainly have. And we look forward to seeing you in the future. Thanks so much.